Good day, and thanks for joining us for our webinar focused on Indiana farmland values and cash rents, the 2020 update. I'm Jim Mintert, Director of the Purdue Center for Commercial Agriculture, and joining me are my colleagues, Dr. Todd Kuethe, who's the Associate Professor here in the Department of Agricultural Economics and also occupant of the Schrader Endowed Chair in Farmland Economics, Michael Langemeier, who's a Professor in Ag Economics and the Associate Director of the Center for Commercial Agriculture. We're going to start off today by kind of reviewing the results from the 2020 survey of farmland values that Purdue's been conducting all the way back to 1970, Todd. So maybe kind of fill us in a little bit on the details on how that survey works, and then we'll start talking about the results.
Sure. So it's an annual survey. We're asking about farmland market conditions around the state. Ask a variety of farmland market experts, basically anybody whose job touches farmland on a regular basis. So rural appraisers, ag lenders, some farmers in there as well. And getting a gauge for where farmland prices sit currently, so June, when the survey is conducted, but also looking back a little bit at the previous December, and then a little bit looking forward to next December.
Okay. And so you've kind of got some details here. You look at more than just one quality of land, right?
Yep. So that's the other thing too, is we collect or release information for three qualities, so top, average, and poor, based on their respondents' belief of long-run commodity price or corn production. But also, it also split up around the state. So if you go to the full report, we have by quality, but also for 6 regions around the state. So collections of about 15 counties.
Yeah, and so sometimes those regional differences are kind of interesting, but not so much this year, I think, is what you were telling us earlier.
Yeah, so I didn't include it in here, and we were talking about it earlier, and that basically we all saw the same pattern, which was an increase from last June to this year over net, but it rose between June and December, and then fell from December to this most recent June.
Okay, so let's kind of look at some of the numbers, right? So why don't you share those with us?
So at top quality, farmland is coming in a little over $8,600, right around $8,600, which is up about 4.5%. That's sort of the number we look at most closely as the top. But poor actually had the highest increase at about 6.3% gain around the state.
And so, Michael, that's always an interesting one. You and I have talked about this a number of times. We've always been kind of surprised at the strength that we see in the lower quality land values here in Indiana. What's going on there?
It's hard to tell what's really going on there. It's both land values and cash rents. Probably what surprises me the most is the high number for poor quality land for cash rent. I mean, yeah, it's lower than the average and top, but if you look at the fundamentals, you know, specifically the yield per acre potential, it always seems high.
Yeah, so one of the things we usually talk about is whether or not in that poor quality land, maybe we're seeing some non-farming interest perhaps bidding that up a little bit?
There's a little bit of that, and actually, you know, if the economic literature, there's a lot of studies about Iowa farmland. Iowa State has a long history, and they always say that most of the pricing anomalies there happen in the lower quality. So a little bit about competing uses. Also, I think when it sells, it's often sort of sold for maybe reasons other than just the ag productivity, so nearby neighbor or recreational use or demand to maybe convert some of that to some other use. Yeah. And so they move around a lot because I think also it's a little bit, maybe, I mean, this is always true with land, but each one is sort of a special case, right? It's hard to get kind of a general pattern. So when you look at sort of the general growth, and that it tends to move around.
Yeah, so you have a little less homogeneity in that poor quality category than you do in the high quality category. That's a good point.
Yeah, and it tends to go up a little bit more when they go up, but it also tends to go down more when they go down.
So just more volatility.
Yeah, more volatility.
Yeah. And one of the things that I've noticed in terms of the top, you know, let's go to the top quality, is if it follows the fundamentals closer than the other two. And so it's not just poor. I mean, the average does track fundamentals better than the poor, but the top really does. And so if you got top quality land, that's usually heavily focused on the fundamentals, specifically interest rate, cash rent, net returns to land, those kinds of factors.
And if there's ever the market ever desires, you know, paying a premium for quality, it definitely shakes out in the land market that it holds its value.
So Todd, in your opening comments, you kind of alluded to the fact that you asked the survey respondents to look not only at what happened on a year-to-year basis, but you try and break that into 2 6-month components. So you look at the last half of 2019, and then you look at the first half of 2020. We've got those results available now, so let's take a look at that.
Yeah, and a big part of that is that the majority of land that's sold is sold in the winter when there aren't crops in the ground, and it's just more of a high activity time of sale. So I think that's why historically they've always asked about December. But what we saw as kind of a really interesting pattern is that prices had been rising. And if you remember, I mean, we'll talk about the history more, but the last couple of years we've had sort of downward trajectory to sort of flat in some areas. And so we should be kind of excited about prices being up, or a lot of people will be excited about prices being up. But we saw this where most of those gains were made in the second half of 2019. Since December, then prices have declined a bit.
Yeah, so softness, and I guess for a lot of us, maybe no big surprise given what's happened with respect to COVID-19, the impact that's had on agricultural prices in general. Obviously, you would think maybe some negative impact there. So let's maybe talk about the numbers a little bit.
Yeah. So again, I was mentioning, so the first half of the year we saw the increases. And again, talking about, Michael mentions poor quality land, goes up by 8.7%, where the rest sort of hang around a 5% increase. And then as we move into the first half of 2020, we see a slight decline of somewhere between 1% to 2%. So they're down a little bit, not a sort of drastic decline, but a lot of our respondents, you mentioned the coronavirus, a lot of our respondents had mentioned, that was one of the concerns that they had in terms of not just commodity prices, but also just sort of the food system in general and the way it changes consumption patterns and, derived ethanol demand through people traveling less. All these have put sort of downward pressure, and they've had to change. A lot of places had to change how they were doing sales. In farmlands, there were would have been in-person auctions of a big crowd. Those moved online or went to listed sales, and so there's some belief that maybe some of that is just sort of apprehension of what's going on in the moment, but also is it a signal of how long is this going to last? And we'll get to it later. But our respondents generally think that this decline, although it's relatively modest softening, will continue through the end of this year.
Yeah. So what about volume? Did you pick up some comments from the respondents about the volume of sales? Did people pull back and maybe not put as much land on the market this spring?
Yeah. And this has been consistent for the last couple of years. The respondents saying that we ask how do the volume of sales compare to the same of the year ago? And they continue to say less. So last year they said less, this year they said less again. So it's just a continuing tightening. And that's what a lot of people are saying, supporting land prices. And as a lot of the fundamentals suggested, land prices could have come down more than they have over the last several years. People are saying, well, it's actually the sort of low volume of sales, keeping that supply tight, that has helped support prices.
Yeah, that's a good point, because most of the time we talk about the factors that influence the demand for farmland, and we don't focus too much on the supply coming to market, and that supply factor can have a pretty big impact. So, well, let's take a look at a little longer term view. So you've got a chart that looks at the average quality land values, both in inflation adjusted terms and in nominal terms, going back to 1970. Pretty interesting chart, I might say.
Yeah, so it's nice to be able to put, we talk a lot about the late 70s, early 80s, and we talked about a lot as farmland prices increased sort of 2004 to 2014 or so. And then as they've come down, comparing that. And so it's nice to be able to put it on a current dollar term. So we say, well, how much of that is just change in general price level? And we can see prices have come down, but they're still historically, even in real terms, controlling for any inflation differences, are still pretty high. They're still very good. We're still, what we were sort of at the height of the 70s, late 70s in terms of, and then in the early 80s, in terms of real prices.
Yeah, so as you look at what factors are influencing farmland values, one of the things you ask the respondents is, what are the factors that were causing you to be optimistic or maybe looking for land values to increase, and what are some of the perhaps negative factors? And we've got a little bit of a summary here. It's kind of interesting to think about the factors people were talking about with respect to having a positive impact on farmland values and what they thought might have a negative impact. So maybe you want to share some of those with us?
Yeah, so the first one there is interest rates, and that's been the big one. Over for sure at least the last 10 years, but historically interest rates have always played a big part. And when I talk to extension audiences, I often talk about our intro to intro to finance class. We talk about the net present value. So we think of how much something should be worth is based on how much we can earn by owning it, but then we want to discount the future because We're not certain the future will happen, so that tends to that discount factor, or our interest rates. Our interest rates are very low. They've been very low for the last since about 2007 or 8. The Fed had been increasing short-run interest rates, but now again with the coronavirus, we've seen a rapid rate cut, and again rates are very low. Particularly when you look at mortgages or long-run borrowing rates are very low, and that helps support land values by making it easier to capitalize or to weight that future income.
So the capitalization factor is a key there. The other thing, though, I think about sometimes, and I hear about from people when I speak to groups around the state and around the nation, is this idea that alternative investments don't look very good, and that makes farmland maybe look a little more attractive.
Yeah, so that's the other thing too, is if you're at a place where you're looking to make, you have some sizable chunk of cash. Obviously, a lot of people don't want to hold cash, particularly now. So you're looking at, well, how would we invest that? Stock market has been so volatile. It seems like, I haven't looked in a couple days. Every couple days, it seems to be different than it was before. Long run, bonds, other sort of investments have been sort of
CD
pushed
rates,
low.
yeah.
CD rates. I mean, CDs. People don't really get CDs as often anymore because it's why drive to the bank and deal with that just to get that low return. And so it's still a very stable set of returns that you can get from owning farmland. And they've been stable for a very long time, so it's a safe asset. And economists have a very precise definition of safe asset, but it basically is that we have a predictable set of returns. So even though they're maybe not as high as what you'd get from other investments, because those other investments are drawn down, now farmland's competitive with those, plus the fact that it's stable. So
yeah. So the other factors people were mentioning: limited supply of land on the market. We've already mentioned that, and then. The one that's always maybe a little bit of a puzzler is people almost always mention inflation.
Which is interesting. And we were talking about this earlier when we were showing the difference between real and nominal. We really haven't had much inflation in the United States or here in the Corn Belt in a very long time, over the course of decades. People are very concerned about inflationary pressures. I know there are a lot of folks who are. I've also heard from a lot of people, particularly central bankers, concerned about deflationary pressure. But farmland is considered a hedge against inflation. Anything that produces commodities. Inflation basically means the price of the things that we buy are going up across the board. So whenever you produce those things that are in everything we buy, that tends to be good with case inflation. I'm a little bit curious what our respondents mean by inflation. If they think this is helping support the land values, that's why we're increasing.
Or impacting interest rates somehow.
Yeah, it's sort of puzzling.
Yeah.
But
they seem to care.
And we were talking about this earlier, and the idea for a long time, 60s, 70s especially, was this idea that as inflation was ramping up, that was supporting land values, and you had the chance perhaps of having an asset that might increase more rapidly than the rate of inflation. But as you point out, that's a little bit of a historical remnant.
Yeah, I think so. I mean, obviously we're biased based on our own experience in participating in the economy, right? So, as a young person, I think I'm biased by. Although I went bald when I was very young, so I maybe don't look as young to the viewers. But we have very low.
The fact that you are young, yeah.
We have very low inflation. We've had virtually my entire lifetime, and so it's really hard to disentangle. Like, how much is it that we think of now as the anomaly of, like, inflation can't stay this low forever. This is a weird thing. We should have more inflation. Versus, well, how much was that high inflationary period, like particularly in the 70s? How much was that the anomaly? And I've mentioned this a lot when I talk to my students, but when Janet Yellen was in charge of the Fed, in her last big speech she gave to the Fed economists, was saying that it's a real mystery what's going on with the inflation economy. That's what economists need to spend time trying to figure out, is where is the inflation. All of the models that the Fed would look at have been predicting inflation. That's, of course, one of their mandates, is to keep inflation at a manageable rate. And it's just not there. So it's a puzzle. I wish I knew more.
Yeah. But it shows up every year on the survey, which is kind of interesting. So on the negative side, Michael, maybe some things that you've been focusing on when you work on some of the budgets.
Yeah, certainly the low net returns, and that's consistent. They break this out into crop prices, livestock prices, and net income actually on the survey. But that's essentially one item in my mind, low net returns, and that's certainly a negative influence. The poor liquidity was actually mentioned in the survey, but we got to think about that a little bit. There's a lot of difference in liquidity among farms. And so when you look at the differences in liquidity among farms, yeah, the average is low, but there's still a fairly healthy percentage out there that have really strong liquidity. And so it's a thin market, and so all it takes is a few people that have decent liquidity. And so I don't think that's as big a factor as the low net returns. But I'd like to get the opinion of both of you on which side here dominates. I really think the positives right now outweigh the negatives. That doesn't mean we're going to see double-digit increases in farmland values by any means, but I think there's certainly enough on the positive side here to suggest stable to slightly higher land prices, even with those low net returns.
Well, we're going to talk about what the survey respondents said, and maybe we'll come back and talk to that. But when I look at the positive side of that slide, which says low interest rates, low returns on alternative investments, and limited supply of land in the market, to the extent that those three remain true, that's going to be pretty supportive of land values either staying constant or maybe a little bit higher.
I tend to think sort of kind of staying sort of where we're at. I think we're in a place where, I could see prices sort of going up or down by 1 or 2%, but anything more than that would surprise me either way, which averages out to about 0. Yeah. So I think it'll hold relatively flat. It'll be interesting to see also what I think is most likely is that we'll start to see more divergence across quality classes and locations. So we mentioned already about how the survey this year, the respondents across quality bands and locations all held sort of the same pattern. And there were some that went up higher and fell farther, but they all held that sort of net gain, except for one instance of a single quality band in one part of the state. I think we'll start to see more of that kind of potentially fraying apart a little bit and seeing more heterogeneity in pricing movements, particularly as if depending on how long the COVID pandemic continues and how that shakes out through the economy. I think that's where we might to see is that it'll be harder to say what's going to happen everywhere. Statewide average, I'd say, I'm predicting sort of close to 0 change.
And I would tend to agree with that. Stable to maybe slightly up, but anyway. Let's see what the survey respondents had to say.
Yeah, so they actually are predicting to continue the decline. So here we show the difference between the actual December and June of this year, and then between what they said of June this year and what they're projecting for this coming December. And they all sort of show a slightly more amplified decline than what we saw the previous 6 months, but not by a large degree. So somewhere between that sort of 1 to 3% decline in the coming 6 months.
So the survey respondents in the aggregate anyway tend to lean towards that negative column that we presented on factors influencing land values in the future, right?
Yeah. Well, depending on what you asked me about in June this year, I was probably pretty negative on most things. So it's probably not all too surprising that we see, suggested or belief that it'll keep declining.
That's a good point, Michael. You and I conduct the Ag Economy Barometer survey every month, and one of the questions we pretty routinely ask people their 5-year outlook on farmland values, and it does bounce around from month to month. So it's not, you're right, it's not constant, right? So
and also the 12-month question bounces around a little bit, and people were more negative back in that May-June timeframe compared to the July Ag Economy Barometer Index.
Particularly, that's right. So, good point. All right, let's take a look at some information you've kind of looked at from a longer-term perspective, because one of the things that's kind of interesting is to think about farmland as an investment over time. So take a look here, Michael.
Okay, let me explain what we've got here, because this is kind of a busy slide. I apologize for that. But the blue line, farmland price to cash rent, is exactly as the name suggests. But keep in mind, this is 5-year averages. This is not a single year. We're looking at 5-year averages farmland price, cash
So
rent.
each point on that slide for each year represents a 5-year average, which is moving
The
over
farmland
time.
price is the current, but the cash rent is a 5-year average, and that's very important to note here. The same with the farmland price and net return to land. That's a 5-year average of net return to land. And the way to think about that is people don't necessarily use 1 year of net returns to make cash rent decisions, or more importantly, farmland prices. And so we're using a little longer time frame there to look at cash rent and net return to land. The fact that the farmland price and net return to land is higher, and has been for the last 4 years, than the farmland price to cash rent ratio suggests that people think that net returns in the future are going to be higher than what they've been the last 5 years.
So some optimism there.
So some optimism compared to where we've been the last 5 years. That's the only way I can really explain this chart. Also, another thing to point out here is both of these ratios are fairly high compared to what they've been starting in 1960. That's when we had the first data here to get that first data point in 1965. Both of them are relatively high. That's where that second part of my title comes in, and historically low interest rates. And so as long as that ratio is relatively high, the only way you can really justify that from a fundamental standpoint is people think interest rates are going to stay low, and I would concur with them that they're probably going to stay low. But the main thing about this chart is the returns we've experienced the last few years. People are more optimistic than that. Otherwise, they would not bid cash rents up as much as they have.
And I guess maybe an alternative perspective on that, Todd, would be that maybe they're more optimistic about farmland returns, or maybe they're more pessimistic about alternative investments.
Yes.
Possible.
I think that's a key factor. When I visit with people that are investing in farmland, one of the things that always comes up is, what are the alternatives, right?
Yeah.
And I think that's weighed pretty heavily on people's decision-making process here. So
Now,
you've taken a look at the 10-year as well.
Yeah, this looks at 10 years of cash rent and 10 years of net return to land. Again, the farmland price is the current price, and this looks quite differently. And here, both of those ratios are very, very similar in the last 2 years. What that leads me to believe is people are looking at the average net returns for the last 10 years rather than the last 5 years when they're making cash rent and farmland price, for cash rent and farmland price expectations, and also this historical low interest rates. This is not a moot point, Jim, because you know, and I know, and Todd knows, and everybody knows that the average net returns the last 5 years are much lower than what they've been the last 10 years. Last 10 years would bring into that average some pretty high returns, and some optimism there.
Yeah, so when you look at the 10-year, you really have two distinct periods. You have the first 5 years, which was a relatively high income period,
Yes.
well, not relatively, very high income
Yeah.
period, followed by a relatively low or lower income period, and people averaging across those implies that they do think they're going to see some recovery in the future, right?
Yeah.
So some optimism there.
And so I think that's a way to, we haven't got to cash rents yet, Todd, but that's a way to explain why the cash rents are where they currently are at. For West Central Indiana, average productivity land, for example, 240 to 250 rather than 210. If you're thinking the returns are going to be a little bit better than what they have been recently, that you would bid that up a little bit. Keep those cash rents up a little higher.
There's a lot of farmers are hesitant to want to let go of land.
Yes.
To think, well, what if I want to get it back in a year or two? Maybe I could take a bad year or a couple bad years, but they're certainly not going to take 10 bad years, right?
Yeah.
But there's a belief of sort of we can take one bad year and then move along as long as I expect it to go back up.
So Todd, the other piece of information you've got to share with us is the fact that USDA just released their annual farmland value survey results here just this week.
Yep.
And you've got some of those to share with us as well.
Yeah, so this is a comparison between our Purdue survey, that's the solid line at the top, and this sort of deeper gold color, and then the two dashed and dotted lines below are USDA numbers. So there's a little bit of difference in terms of who the survey. So they're both conducted in June, which is nice, but the USDA surveys farmers, and they ask farmers, what do you think the value of your land is? And they split it into 2 or 3 different categories. Here I've shown the 2 of cropland, so that's just sort of bare cropland. And then farm real estate includes value of land and buildings or other improvements. And so you can see we track pretty closely, particularly sort of around until about 2007 or 8, and we see a little bit more of a divergence. Since then, our survey has been a little bit higher, but we're consistent in terms of the USDA is basically, theirs is always a much smoother series than you tend to get from smaller surveys that like we do here at Purdue or some other universities. And so they've held basically flat since about 2017-16.
If you look at data from other states, Todd, I know you've looked at this too. Iowa and Illinois would be a similar situation, where the individual state surveys are showing a higher peak than what the USDA did.
Yeah, and I used to work at the USDA, and so I'm very familiar with the state. If anybody wants to nerd out and talk about how it's designed and conducted and why I think that is the case, but they are dealing with a big set of data and it gets aggregated and smooth. And so part of that richness is you get maybe a better measure of average in some ways, but you're also considering a lot more things as average, right?
Yeah.
So those respondents are responding to the value of the land that they farm, and to be a farmer for the USDA, you just have to have $1,000 of production a given year, right? So I think that's maybe different than when you talk to people who work in the land markets that are thinking of buying and selling or accepting land as collateral. They're maybe thinking of a different subset of land.
I think it's the marginal versus average.
Yeah.
You know, on the margin, I mean, there's only a few buyers, and they're the people that are paying for the farmland and keeping the cash rents higher than it would be normally. So I think it makes sense from that standpoint.
Yeah, and the work that I've done and research, that the USDA number tends to track the median of sales prices, right? So it's that half that splits the top and bottom. As opposed to the average, which with prices always kind of gets pulled up because we have, some of these very few high value sales will pull up that average, but the median's unaffected, right? Yeah. So, but it's always interesting to see sort of where we come in with compared to the USDA. And when I used to work for the USDA, everybody would want to talk to me about why the USDA was wrong. So I always like to take a look still.
We've been asked that question too.
Yes.
So you've taken a look at USDA numbers, not just for Indiana, but really for the Corn Belt. So let's talk about those.
Yeah, so if we look here across the Corn Belt, so the top number is the average value per acre for cropland in the Corn Belt states. The bottom number is the percentage change from 2019, so what they're showing is change. So they're showing no change here in Indiana as well as in Illinois. Slight increase in Ohio and Missouri, and a slight decrease in Iowa. So Iowa had the higher run up, but it's sort of slipped down a little bit more, and it sort of continues to slip a bit.
Yeah, so it's kind of interesting though, if you look at across the Corn Belt, basically that says essentially almost no change, right? If you start aggregating across those states.
Yeah, and depending on, as long as you're not selling something, if 1% price change, virtually the same, right? So, so this is the sort of the history. If I just broke it down just to the I states, get a little too crowded if we put the whole Corn Belt in there. And I have to see my native home state of Missouri hanging down below the rest of the Corn Belt. But here you can see that in this last year, Illinois is slightly higher than Iowa, but Iowa had been above Illinois, the rest of the I states for quite a while. They had the highest peak in that period of 2014. So they've come down a little bit more, maybe a little bit of convergence there in the difference. And Indiana just below both Illinois and Iowa, but it's held relatively stable over the last year or two, several years.
So let's kind of summarize the results on land values before we start talking about cash rents. So from June 2019 to June 2020, you saw a survey respondents said prices up, actually pretty significant increase that last half of 2019, right?
Yeah, particularly, even with the slip we've seen since December, we're still net up 3 to 5%. I think a year ago now, if you guys would have said, hey, we're going to get 3 to 5% increase next year, people would be very excited about it. So even though we've had that little bit of slip since December, it's still a net gain over the year. It's pretty good gain, I think.
And looking ahead, the survey respondents said they think we're going to see some more softness in the last half of this year.
Yep, slightly more than we saw in the first half.
And just to kind of summarize those key drivers, farm income, commodity prices, interest rates, and limited supply of land on the market, right? Mm-hmm. So I have to throw one other thing in. All three of us wind up talking to people that are actively engaged in the farmland market, and we hear stories, right? And some of those stories suggest that maybe there's a little more strength than maybe what we picked up in the survey. What's your reaction to that?
Yeah, particularly talk to folks that are in sales here in the Corn Belt. I always hear the prices are really good, or the last several months I've been hearing prices are very good. but they're often also caught with they're much better than we thought they would be, right? So even places where they have slipped, maybe they didn't slip as much as they're expecting. Particularly when you think about the way sales are conducted, where you can't do in-person auctions of big groups and moving stuff online. But talking to people that are working in the farmland markets, there's definitely, of the land that's sold, seems to be selling at a pretty good price. And even especially in the last, since our survey was conducted, I've heard from a couple people that say prices are doing well.
One of the pieces of information we often don't have, Jim, is let's go to that limited supply. I think there's people that have held land off the market because of the COVID-19, and how big was that group? How limited is the supply compared to what it would have been otherwise? I think that's a big factor.
Yeah, I mean, one of the factors about farmland, I think you've probably looked at this at some point in the past, and the annual turnover rate in farmland is quite low. So relatively small changes in the number of people that choose to put farmland on the market can have a noticeable impact on prices.
Yeah, as far as land that's sold on the open market that any of us could buy, it's about 1% of farmland across the country. So it's really small. I also think, similar to what Michael was saying, I mean, if you had an income generating asset and there's an economic slump, it's not a time to unload unless you have to. So I think there are probably a lot of people that are holding on to see what's going to happen.
Yeah. All right, let's talk more about cash rents. So why don't you share the results with us from the survey?
So cash rents, similar to land values, are up a little bit higher, though, actually, sort of 4 to 5% across the state. So here we have this a statewide average again, at the top, average, and poor. And if you're interested in the, I should also mention to any of our viewers, if you're interested in the how they vary around the state, that's on our report as well. But at the top, we're seeing slight increases of 4 to 5%.
So, Michael, are you surprised by that?
Yes, I was quite surprised at that. I thought they might be up, but it'd be less than 2%.
Yeah.
I was thinking negative 2% decline to 2% increase, and so when it busted outside that range, I was surprised. Yes.
So, what do you think the driver was there?
I think one of the big drivers was the large government payments in 18 and 19. I think that contributed.
So the MFP program had a positive influence on people's liquidity?
Yes.
And
I think if you look back in 19, I think the crop turned out better than a lot of people thought it was going to. That matters when you're negotiating those cash rents for 2020 in the fall of 19.
Yeah, good point.
And I think people were generally optimistic in the fall of 19, thinking that they'd turned a corner and that a lot of the challenges we'd had with marketing and production of 19 as well didn't end up being as bad as they thought. So I think people were relatively optimistic.
Yeah. That's a good point, because if you go again look back at the Ag Economy Barometer, we have the all-time record high since we've been collecting data in 2015 was in February of this year. So end of last year, beginning of this year, before COVID-19 hit, people were pretty optimistic. In fact, more optimistic since we've been collecting data.
They weren't talking $3 corn, put it that way.
That's a good point. So let's take a look at the rental rates over time this time, right?
Yeah, so this is, again, inflation adjusted. And what's interesting, on a real term, land prices, or cash rent, have held relatively steady. Though we had a little bit of it rose and fall over that sort of 2005 to the last 15 years or so. But it's held relatively stable since the mid-1980s. And so we have this little bit of an uptick, but it's all sort of still in that kind of comfortable zone of what cash rents appear to be.
So looking at those real terms, again, a modest increase, right, for 2020 versus 2019 of about $10 or $11 an acre. And then you've looked at the cash rent to land value ratio, and that's the one that's of concern not only to farmers but some of those non-farm investors as well.
Yeah, and people that inherit farmland or so the easiest way to make money when you own farmland is to just rent it out to somebody else and have them do the hard work. And so I always look at that ratio of what is the cash rent to the land value. So if you own land, what can you expect to make on the rental market? And that's held at about 3% since 2015. It's held relatively flat. And so we haven't had any action there. We're still below sort of what the long run average would be of that ratio, but it's held very stable.
And when I visit with non-farm investors, they look at that 3% and start making comparisons of that to what you could earn on a CD, for example.
Yep.
And that explains why some people that perhaps aren't farming are at least interested in either retaining ownership of farmland or in some cases maybe stepping in and purchasing.
Yeah, anyone who's concerned about retirement, if they say, well, for every dollar you give us, we'll give you 3% return, that always looks attractive.
Yeah. Certainly in relative to what you can get on a CD these days, right?
Yeah, exactly.
So let's take a look at that on more of a Corn Belt basis.
Yeah, and again, sort of general story of no change. Same thing we saw with cropland values, which I should mention, as economists, we would hope that would be true, that you don't want to have cash rental rates and land prices getting too out of whack. So when you see sort of stable in one, staying stable in both is always is a nice thing to see. It shows we're at an equilibrium, but we're relatively unchanged here across the Corn Belt.
And then you looked at a little more detail at the I states.
Yeah, and again with the I states, Indiana we're hanging just below Iowa and Illinois. Although interesting enough, Iowa still has slightly higher cash rents than Illinois, which is sort of the craplon values. Illinois had edged out Iowa. I spent some time living in Illinois, so I know about the cross-state rivalry there. But we see this sort of general pattern of cash rents have held relatively stable since about 2015 across the I states.
So let's kind of summarize cash rent summary here in Indiana, up 4 to 5%.
Yeah, increased enough to surprise Michael, but at pace with land value increases over the year.
And I guess maybe the driver there, I think that second point in the slide kind of points it out. Cash rent to land value ratio held steady, right? And that was maybe one way to look at why cash rents did what they did, right? So. Michael, you've taken a look at cash rents and net returns to land and have a projection on there for the 2020 crop.
Yes, this tells a little different story in terms of what 2021 might look like. I think, Todd, in the actual survey, it was very flat in terms of the cash rent expectations for 2021 or the upcoming year. This chart suggests something a little bit different. I'm more of a Dr. Doom when it comes to cash rents. Even though I'm optimistic on land values, I do think there's some strong downward pressure on cash rents, depending on what the federal government does in terms of an MFP type payment later this year. But if you look at the payments that we currently have in terms of government payments, forecasting an Ark County PLC payment and then also a CARES Act payment, the net return to land with $3 corn and soybeans that are not too good either compared to previous years perhaps, you're looking at a pretty low return, and even lower than 2015, after which we saw a pretty large decline in cash rents. And so that gap between cash rent and net return to land, in my mind, suggests that we're going to see some downward pressure on cash rents in 2021. And so I've been telling people that I think even though cash rents and land values have been pretty much highly correlated the last few years, I think we could see a divergence in that in the next year or two, where we actually see a little bit of strength in the land market and not so much strength, even some decline in the cash rent. I think the fundamentals are different for those two markets. The cash rent is heavily focused on the net return to land, whereas the land market, you got the net return to land and cash rent, but you also have low interest rates, alternative investments, and some of these other things that are positive when you look at land values and not so positive when you look at cash rents.
Yeah, so I'm looking at the chart, Michael, and you've got that projected for 2020 net return to land here in West Central Indiana of roughly $100. So about a 50% decline in net return to land compared to last year.
Yeah.
And as we've alluded to some previous programs, even with the CARES Act in there, it doesn't match what we got from the MFP program these last couple of years.
Now, one of the things when you're looking at this cash rent and net return to land, obviously net return to land is much more volatile. We've done some statistical analysis looking at the relationship between these. If you see something like a $100 decline in net return to land for a given year, you're looking at the historical relationship. That suggests that there might be as much as $10 decline in cash rent. So the decline in cash rent is usually only about 10%. As big as the decline in net return to land. And so even though there's a $100 difference there, that doesn't translate into cash rent crashing, but it does create a situation where you could see cash rent $10 or more lower than what it is in 2020.
The argument I often get is people saying, I can't bid it down, right? Sort of who has the power. And it seems like any time I talk about the relationship with rent and value, I either frustrate farmers who are wanting to bid down cash rent, or I frustrate the landowners and say, quit telling them the rent should be lower, right? And I think there's a lot in that bargaining process across the market in terms of how well this, we can put.
And I would concur. The way I would look at that, Todd, is if the gap is, and we see here in this chart, the net return to land has been lower than cash rent since 2014. And in some of those years, there wasn't a decline in cash rent. In fact, in 20 there was actual increase. And so, in my mind, it takes a pretty large gap. That's why I look at 2015 there. We had a pretty large gap between cash rent and net return to land in that particular year. And you can see in 16 there, we had a pretty large decline in cash rent. And so to a certain degree, I agree with you. If the gap there is not real large, I think we just kind of keep cash rent steady. Is when you see these big gaps like this is where I think there's more pressure for a downside adjustment.
And I think there's some, obviously a lot of people out there that are betting on the idea that we may see the pattern you saw between 10 and 11, 12, to where we're going to have a rebound and prices up. But like we mentioned at the very beginning, how long can you afford to hold on to that land at a loss? How big of a loss until you have to, something's got to give.
And there are fewer people today that have the liquidity to support those cash rental rates compared to, say, 5 years ago.
Now, we should point out that we do have a cash rent spreadsheet on the Center for Commercial Agriculture website where you can plug in budgets for corn, soybeans, and if you have wheat down south, you can also plug that in, and then you also plug in some assumptions on where you think prices are going in the next 5 years, and it allows you to compare net return to land to cash rent for the next 5 years to get some handle on how big that gap looks, not only in the 2021 period, but over the next 5 years. And if the gap looks really big there, then you need to tell yourself, I think you need to ask yourself at least, can I afford to have a $50 gap? $50 plus gap for 5 years. Here we're looking at 1 year, but if that looks like it's going to be like that for 5 years, then can I afford to lose $250 in working capital? And so those are the kind of questions that cash rent spreadsheet helps answer.
Yeah. So a lot of those cash rent discussions are getting underway about this time of year, and we'll be continuing here for the rest of the fall and into at least part of the winter. So it's going to be interesting to see how that shakes out. So that wraps up our discussion today. I want to thank you for joining us. We have another webinar coming up here just next week. USDA is going to release its August crop production report, as well as an updated set of world ag supply demand estimates. And we'll have a panel that includes myself and Michael Langemeier, but also our crop production specialist from the Department of Agronomy, Sean Castile, the soybean specialist, and Bob Nielsen, our corn specialist, Beth Hall, the Indiana State climatologist, and then Marlo Johnson, who's the regional director for USDA's NASS agency, sharing the actual details from the report. So we hope you'll have a chance to join us for that. That'll be next Wednesday, August 12th at 1:30. So you can register for that on our website, which of course is purdue.edu/commercialag. And as Todd pointed out, if you want to dig into the details, and I think a lot of people viewing this probably do want to dig into the details, the detailed report with more details than what we were able to share today is available on the Center for Commercial Ag's website, and there's some links on the home page, and you should be able to find that pretty easily. So with that, I want to, on behalf of my colleagues, Todd Kuethe and Michael Langemeier, I want to thank you for joining us.